Hello. On behalf of Fair Value Academy, welcome to the module on market multiples. Just a quick background about Fair Value Academy. In addition to providing new content on valuation for accounting and financial reporting purposes, we are also a fintech company. Thanks to our cutting-edge evaluation platform, we can assist you with all of your fair value needs and provide detailed valuation models and valuation reports for a fraction of the price that you are paying now. And our quality is comparable to top-tier valuation advisory firms. All you need to do is answer a few questions, provide certain financial data, and our platform will generate a defensible fair value. We offer business valuation, goodwill impairment assessment, purchase price allocation, valuation of ESOPs, convertible bonds, preference shares, and intangible assets. We can also assign you an analyst to handle queries from your auditor. Visit www.fairvalueacademy.org to learn more. Now let's jump into today's session, an introduction to market multiples. Looking back at our diagram on business valuation, in this module, we will focus on the market multiples approach to valuation. This is a relative approach, as the value of a business is derived in relation to the pricing of its comparable companies. So what this means? In simple terms, you look at the market, the price of companies which are similar to you, and then you price yourself accordingly. Valuation professionals, investment bankers, and investment analysts prefer the market approach over the DCF approach, as it is easier to do, but more importantly, it makes reference to market prices, which is easier to defend, and unlike the DCF approach, which is very heavy on assumptions. The easiest way to illustrate the market approach is by using the example of someone selling their home. Say you have a 3-bedroom apartment in central London, which you want to sell, and the size of the apartment is 1,000 square foot. The question is, what is your house worth? How much do you sell for? Step 1 is to look at recent market transactions in central London for a property which is similar to your home. And here we identify 3-bedroom apartments with similar characteristics to the house that we want to sell. And these 3-bedroom apartments were recently sold. So these are recent market transactions. If we solely look at selling prices, it doesn't tell us much. As you can see, you have property selling for almost 3 million, 5 million, and 2.5 million. To make this comparable, we look at price per square foot. And this is more meaningful as we can compare, and clearly we can see that the apartment in Trevor Square is the most expensive, whereas there's one in Harrods, which seems to be the cheapest. And we deduce that the price per square foot for a luxury 3-bedroom apartment in central London is around 2,700 per square foot. So let's look back at the 3-bedroom home which you want to sell, which is 1,000 square foot. How do we value this? If your property is 1,000 square foot, and we know that the average market price is around 2,700, then the value of your home should be worth around 2.69 million. I am not here to teach you property valuation, but I think this is a good example to illustrate or to teach the concept of multiples. And I want you to think of the price per square foot as the multiple and the number of square feet as the earnings of a company. And these two metrics give you the equity value of a company. It's called the market approach because these are derived from the market. As I showed you, price per square foot came from market transactions. And P multiples are also derived from market transactions, since we are taking the trading price per share. So when a share trades on the stock exchange, we take the price per share from that transaction on the stock exchange, and we divide it by earnings per share, which we get from the publicly available financial statements. So as you can see, the PE multiple is also referenced from market transactions. When we hear price per square foot is equals to £2,600, this tells us that 1 square foot of luxury property in central London is worth £2,600. However, what does a PE multiple of 10 times mean? It means that if a company's PE multiple is 10 times, this tells us that every dollar of earnings that comes out of this company is worth $10. Now, it may not make sense at first, so let me explain further. In this example, we have Company A and Company B, which are in the construction industry, and both have last 12 months earnings of $1 million. However, Company A is trading at a 10x PE multiple, whereas Company B is trading at a 7x multiple. So the question is, if both companies are in the same industry and have the same earnings, why is one trading at a higher multiple? And usually it's because of two things: risk and growth prospects. Company A is either less risky or it has better growth prospects than Company B, and that's why the market or the PE multiple is higher. So let's investigate further and try to understand why is Company A trading at 10 times earnings, whereas Company B is trading at 7 times. And what I found was that Company A had signed agreements with the government to build roads and bridges for the next 8 years, whereas Company B had projects in the pipeline for only 3 years. So clearly, as an investor, you would be willing to pay more to invest in Company A because it's less risky. It has signed agreements for work for the next 8 years. And when you buy a business, essentially you're buying its future cash flow stream. Company A has a secured cash flow stream for 8 years from its contracted work, whereas Company B has some uncertainty and will need to go and find new projects after 3 years. So to conclude, even though they have the same net earnings, to an investor, $1 of earnings from Company A is worth more than $1 of earnings from Company B. This was a very simplistic example, but we will delve deeper in later sessions.